The worst is yet to come for the housing market, and it could hit harder than anything we've seen in decades. If you thought the market was bad now, wait until you see what's next. Are you prepared for what's on the horizon? The storm is only starting, and it's about to take down everyone in its path. Buyers, sellers, renters, no one is safe. The consequences could change your financial future forever. The housing market has been on a wild ride, and the worst is far from over. Over the past few years, home prices surged by 25 to 35% in many markets from 2020 to 2023, fueled by record-low mortgage rates and a surge in remote work relocations. The pandemic reshaped where we lived, making housing a top priority. With demand sky-high, sellers could set premium prices. For many, buying a home felt like a golden opportunity. But this boom wasn't sustainable. As inflation spiked, the Federal Reserve raised interest rates to control rising costs, and mortgage rates followed suit. By mid-2024, the average 30-year mortgage rate had reached 7.3%, a level not seen since the early 2000s. This surge in rates turned what was once an affordable market into a full-blown affordability crisis. The current housing market is like trying to balance a heavy load on a thin wire, and it's ready to snap, says Mark Zandi, chief economist at Moody's Analytics. As mortgage rates climbed, demand for homes fell. By late 2024, home sales had dropped 21% year over year. While home prices have cooled, they remain high, with the median home price in the US at $410,000 in January 2025. Housing inventory rose 15% compared to 2023, but buyers aren't rushing back, and sellers are feeling the pinch as they face a market that's shifting under their feet. Why? Affordability. This led to a buyer's strike. More buyers are hesitant, many opting to rent or wait for the storm to pass. Sellers are unwilling to lower their prices, causing a standstill. We're trapped in a cycle of high rates, low affordability, and limited inventory, with no easy solution in sight. The housing market is stuck in a slow-motion disaster, and while some consequences are already showing, we're just beginning to see the long-term effects. The full impact on buyers, sellers, and homeowners will unfold in the coming years, and many will feel the repercussions for years to come. Let's face it, mortgage rates are a massive roadblock for anyone looking to buy a home in 2025. Right now, the average 30-year fixed mortgage rate is hovering around 7.3%, and it's not showing any signs of coming down. This is a stark contrast to just a few years ago when rates were as low as 2.5%, leaving potential buyers facing a reality where home ownership feels more out of reach than ever before. To give you a clearer picture, a $400,000 loan at today's rates is now $1,300 more expensive per month than it was in 2021. For many would-be buyers, this means the homes they once dreamed of are now simply unaffordable. Michael Ferroli, chief economist at JP Morgan, has called this rate hike a silent killer, warning that high rates will continue to put enormous pressure on home affordability. As mortgage payments climb, many buyers are opting out of the market altogether, leading to a significant drop in home sales. In fact, home sales fell by 23% in 2024, and mortgage applications plummeted by nearly 30% year over year. What's even worse? The supply of homes is still high, but demand is sinking fast. This has created a deadly deadlock in the market. Sellers are hesitant to lower their asking prices, fearing a loss in value, while buyers are reluctant to pay top dollar with interest rates at these levels. As a result, we're seeing a stagnation in the market, a vicious cycle that's fueling the affordability crisis. So, what does this mean for home buyers? The dream of owning a home is slipping further away, and with mortgage rates staying high, many are being forced to wait, or worse, They're simply giving up on home ownership altogether. The housing market is tougher than ever, and it's leaving millions in a state of uncertainty. The situation is about to get even scarier for homebuyers and homeowners alike. One of the biggest issues facing the housing market today is inventory, or more specifically, the lack of it. According to Redfin, the number of homes available for sale is still 40% lower than pre-pandemic levels. While demand remains reasonably strong, the available supply of homes is incredibly limited, creating a dangerous imbalance. But what's making the inventory crisis even worse is this: fewer homeowners are listing their properties. A big reason for this is that many people are holding on to their homes because they don't want to give up their ultra-low mortgage rates. For example, if you bought your home at a 2.5% mortgage rate and now face a 7.5% rate, why would you sell and take on such a hefty financial burden? This reluctance to sell has created a bottleneck in the market. Demand from buyers is high, but supply is at an all-time low. Here's the real fear. If you bought your home in 2022 or 2023, when prices were at their peak, the value of your property may already be starting to decline. In fact, Zillow has predicted a 3 to 5% price drop in most major cities across the US in 2025, with certain markets like San Francisco, Austin, and Seattle possibly seeing even steeper declines. If this continues, many homeowners could find themselves in a situation where they owe more than their home is worth, a position known as negative equity. This is especially troubling for those who were hoping to sell or refinance their homes in the near future. As Blitzer put it, for many homeowners, the equity they've built over the past decade could disappear if prices continue to slide. This isn't just a small problem, it's a looming financial crisis for homeowners across the country. In the next 12 to 18 months, if home values keep declining, many could find themselves underwater on their mortgages. This is a scary situation for anyone who's invested in real estate, and it's a harsh reality check for the housing market. Before we continue, take a second to like this video. It ensures more people see our work and keeps us energized to create more. Now, back to it. You've probably heard the term "wait it out," but the real question is, how long should you wait? With the current state of the housing market, many buyers are adopting a wait-and-see approach, hoping that prices will drop or that mortgage rates will go down. But what if this waiting game ends up costing you more in the long run? Here's the issue. Not every market is going to see drastic price drops. In fact, some areas, especially those with strong economic fundamentals, might only see modest price declines or even a plateau. Cities like Dallas, Miami, and Phoenix are prime examples of markets that are likely to remain resilient despite the high interest rates. Why? Because there's still significant demand for housing in these areas, driven by job growth, migration, and local economic strength. Experts are cautioning buyers who think they can just wait for a drastic price drop. Waiting indefinitely for prices to fall could be a mistake. If you're in the right market, it's better to buy now while there's still inventory than wait for the uncertain future, says George Ratiu, senior economist at Realtor.com. Furthermore, the longer you wait, the more you risk missing out on the home you really want. With inventory already low, there's no guarantee prices will drop much, especially in hot markets where demand remains high, adds Danielle Hale, chief economist at Realtor.com. For many potential buyers, the window of opportunity may not stay open for long. Holding off in hopes of a significant market correction could leave you stuck, watching from the sidelines as prices stabilize or even rise in certain areas. Waiting could seem like the safe option, but it might not be the smartest move in this unpredictable housing market. Let's talk about renters for a moment, because they're not escaping the pain either. In 2024, the average rent for a two-bedroom apartment shot up 7% year over year, reaching approximately $1,800. But in major cities like New York, San Francisco, and Los Angeles, renters are seeing prices soar to $3,000 for a modest apartment. It's clear, renting is no longer the affordable alternative it once was. What's driving this surge? Landlords, struggling with their own rising mortgage payments, are passing those costs on to tenants. Many are raising rents just to keep up with their higher operating costs, which means renters are feeling the squeeze from all sides. Renters who hope to save for a down payment are finding it nearly impossible when a significant chunk of their monthly income is going towards rent. The reality is simple. Whether you're buying or renting, affordability is the biggest challenge right now. We're seeing affordability hit a 30-year low, and it's impacting renters just as much as potential buyers, says Lawrence Yun, chief economist at the National Association of Realtors. In fact, renters are now facing some of the highest monthly expenses in decades, with little relief in sight. With rents climbing at such a fast pace, renters are being priced out of markets, and the dream of home ownership feels further and further out of reach, says economist Molly Boesel. Renters aren't just feeling the pressure, they're caught in a tight spot, where saving for a future home is becoming harder with each passing month. This rental crisis is just another piece of the puzzle in an already difficult housing market, making it even tougher for many Americans to make progress in today's economy. This ongoing struggle leaves renters with fewer options and even more uncertainty about their financial futures. One major question on everyone's mind right now is how government policies will impact the housing market during this turbulent time. Will relief programs, affordable housing initiatives, or tax breaks for home buyers be enough to ease the financial strain caused by high mortgage rates? Or are these measures too little, too late? Historically, government interventions have played a crucial role in stabilizing housing markets during times of crisis. In the past, programs like mortgage relief and first-time homebuyer tax credits helped turn the tide, says Lawrence Yun, chief economist at the National Association of Realtors. However, in today's global economic climate, some experts are skeptical about how much impact these policies can really have. Many argue that with inflation still high and global financial challenges ongoing, the effectiveness of government interventions is unclear. We may see some short-term relief for certain buyers, but these policies are unlikely to fix the broader structural issues that have caused this housing crisis, warns Mark Zandi, chief economist at Moody's Analytics. The real question is whether we'll see a full bailout for the housing market or if buyers and sellers will have to navigate these troubled waters on their own. As of now, the jury is still out, and it's crucial to keep an eye on any policy changes or government actions that may shift the landscape. What we do know is that, as the government weighs its options, it's up to individual buyers, sellers, and investors to take proactive steps. While relief might come, it's not guaranteed, and it's unlikely to solve all the problems the housing market is currently facing. The real challenge lies ahead, and government policies may offer only partial help, if any at all. So, with all these challenges in mind, how can you protect yourself and even thrive in today's housing market? Experts suggest several strategies to navigate through the uncertainty. If you're considering buying, don't wait around for rates to drop. Mortgage rates are expected to remain elevated for the foreseeable future. Waiting for rates to drop could leave you behind, says George Ratiu, senior economist at Realtor.com. Locking in a rate now could save you thousands in the long run. If buying feels out of reach right now, consider rent-to-own opportunities. This option can give you flexibility while waiting for the market to stabilize, without missing out on potential homeownership down the line. One of the best ways to prepare is by saving for a larger down payment. The more you can put down, the less you'll be impacted by rising mortgage rates or a potential price dip. The stronger your financial foundation, the more control you have in an uncertain market, says Dave Ramsey, financial expert. Focus on areas that are still affordable but show strong economic growth. Cities like Tampa, Charlotte, and Indianapolis are seeing solid growth despite high rates, and they could offer better opportunities for buyers. Lastly, whether you're buying or renting, avoid stretching your budget too thin. Make sure you can comfortably afford the home, even with high interest rates, advises Danielle Hale, chief economist at Realtor.com. This will help ensure your financial stability through unpredictable times. By following these steps, you can better protect yourself and position yourself to thrive, even in one of the toughest housing markets in decades. The housing market storm is just beginning, and if you're not prepared, it could hit hard. But here's the good news. With the right strategy and mindset, you can still come out on top. Stay informed, adapt, and make smart choices. It's the key to navigating the chaos ahead. Drop a comment below. What's your plan for dealing with the housing market in 2025? We'd love to hear your thoughts. If this video helped you, hit like, subscribe, and turn on notifications so you never miss an update. And for more insights on navigating today's economy, check out our video, U.S. Debt Crisis, Janet Yellen's Last Warning to Congress. Thanks for watching, and let's weather this storm together.